Well, welcome everyone. Happy to have Charles Blakely from Gemminar Asset Management here today to discuss markets, both little summary of last year and then looking at three possible scenarios for this year. And I think, one of the things that's been especially challenging this year is it feels like there's new news coming out every day that impacts the economy, impacts markets, and it's hard to keep up with. It's hard to know, which of these news stories are impacting your portfolio, and which are just noise. So I think, who better than Charles to look at kind of all of this data and put it together in a summary of what we're focusing on and impacting your portfolio, markets, the economy, and what else may or may not really matter all that much. So welcome, Charles. Looking forward to doing this presentation with you. Charles is going to run through a presentation on the market outlook. I'm going to hop in. We're going to talk generally, but I want to encourage you that if you have questions specifically to your portfolio, questions specifically to your retirement plan, that we get together and have a planning meeting to go through that together. So I'm going to hand it over to Charles, and I'll hop in and interrupt a couple times, but Charles, I'm going to hand it off to you.
Great. Thanks, Lev. And hello, everybody. Thanks for taking time to listen to this recording. So just briefly, I'll give you a sense as to what the markets did last year and how they're doing so far this year. Just put some numbers on the performance. So this table is showing you the right-hand red box with the returns for last year. So, obviously it was a good year for stocks. You can see global equities were up 16.5. S&P did particularly well, up almost 25%. And the other indexes, small cap and international, were up. They lagged the S&P because really returns were driven by the Magnificent Seven last year, those big seven tech stocks that drove S&P returns. So international markets lagged US last year, although that's reversed this year that I'll hit on here shortly. So it was a good year for stocks in 2024. The other piece that stands out is what happened with interest rates. So you can see the yield on the 2-year Treasury basically was unchanged for the year. But longer term yields, so the yield on the 10-year Treasury went from 3.88 to 4.57%. So it was tricky in the bond market. If you were short maturity, short duration, as the terminology would be, you're up 3-4%. But if you owned long-term bonds, it's quite likely you lost some money last year. There was very divergent performance in fixed income in 2024. So far this year, so I put these numbers together here just a few minutes ago. So this shows you returns through last Friday, so through Valentine's Day. So markets have got off to a good start. You can see global equities are up 5, S&P's up 4. What really jumps out, and I think it's surprised us and a lot of people, is the international markets, particularly Europe and Japan, have beat the US this year. The EFI, as the international index, is up 8.4. And with all the uncertainty about what's happening with Europe and tariff policy and trade, and now what's going on with Ukraine, European markets have done surprisingly well. Fixed income has rallied, so bond yields have come down, prices have gone up, so bonds are in the black so far this year. So it's a good start to the year, despite all the uncertainty that's sort of been weighing on sentiment the last few weeks. So where are we going? So rather than sort of outlining one view as to where the economy and the markets are going to go, I'm going to throw out 3 different scenarios, and maybe that helps you think through where you lie. You're more in this scenario than another scenario. And then at the end of it, I'll give you my probabilities, right? It's all qualitative. There's a big element of guesswork here, but I'll give you a sense as to where I'm at, and you could get an idea. Do you agree, disagree with our outlook for the next 12, 18 months? So scenario 1 is the one that's talked about all the time. It's, we're on the cusp of a recession. And so if you've been reading anything in the popular media the last 3, 4, 5 years, it always seems like we're on the cusp of a recession. I think a big part of it is the Fed has raised interest rates. So this chart is highlighting all the previous rate hike cycles going back a few decades. And if it's highlighted in yellow, it means that rate hike cycle ended in a recession. So I think two key points here. Most rate hiking cycles do end in recessions, but not all of them. So there's a couple of black lines there that are not highlighted. If you think back to 94, 95, if you were in the markets then, the Fed raised rates significantly. Orange County went bankrupt, if you remember, but we didn't get a recession in the United States. And so I think, the recession would not be our base case outlook. I think it's a low odds scenario, although there's a lot of variability, right? We don't know how much spending could be cut under sort of the DOGE program, whether that's going to be significant or not. And as I'll get into here shortly, we don't know what's going to happen with fiscal policy. But the first scenario is we get a recession.
Hey, Charles, is there, you mentioned, the rate Fed tightening. Is there anything else that could happen that would cause a recession, other than, we're kind of on at the end of a tightening cycle, or maybe we see more tightening, but anything else that could happen that would be recessionary?
Yeah, that's a good question. I think, as I alluded to, I think a big cut in fiscal spending could do it, right? So much of growth over the last 5, 6 years since COVID has been driven by significant fiscal expansion, fiscal spending. So if that reverses, that could trigger a recession. And then there's always a shock to the system, a big oil shock, a Middle East war, sort of those outlier events. But at least for the US, we're relatively insulated from a spike in oil prices. So I think the biggest risk, to my mind, would be a big contraction in fiscal spending that's not anticipated.
Thank you.
I think the reverse of that is we get a big expansion in fiscal spending that leads to another bout of inflation. And so this chart is showing you debt to GDP in the United States, and the black line is basically the course that we're on now. So it's from the Congressional Budget Office, and it's showing basically debt to GDP is likely to grow from 100% to 125% through the end of 2035. So that it's an increase, but it's not an enormous increase. That probably isn't inflationary. Then those other dotted lines are different combinations of the new administration's fiscal ideas. And so depending on how you put them together, different proposals, the low cost projection is, we could see a tax plan that increases debt to GDP by a little bit, but if under other assumptions, it could go up by quite a bit. So, that would be an extension of the 2017 tax cut, renewed tax cuts on corporations, right? Exempting Social Security and tip wages from income tax, and you go on the list. And so obviously we don't know where we are on this path because we're sort of in the negotiating process at the moment. But to put a number on it, the difference between 125% debt to GDP and 161% would be an additional $9 trillion of spending over 10 years. So in my mind, if that comes to fruition, if we see the policy decisions that put us on that upper bound, that upper line, that could very well be inflationary. We're just not there yet, but we could be if Congress makes a certain set of decisions. I think the other piece on the inflationary outlook concerns tariff policy. So obviously it's a hot topic. It's been in the news a tremendous amount. The blue line on this chart shows you effective tariffs going back to 1900. And then each of the red dots shows you some combination of tariffs on China, Mexico, broad tariffs on everybody. And I think we're not sure where we're going to land on this chart, whether it's the lower red dot or the upper red dot. There's so much that's in flux at the moment. It's hard to say with certainty that tariffs for sure are going to be inflationary, or tariffs actually are going to hinder growth. If it weighs on growth, very often that's deflationary. So there's two sides to the debate on tariffs, and it's not clear that they're inflationary at this point.
Interesting.
I think the overarching point, too, on the political piece, on the inflationary scenario, is just what can get passed through the House and the Senate. And so this chart shows you the majorities in the House going back to 1900. And the point here is that the Trump administration, the new administration, has one of the narrowest margins in the House in history. So it's less than clear, right, what can be passed through the House at this point, because even the Republicans in the House are not a unified bloc, right? You have very disparate opinions amongst House Republicans on fiscal policy. So that's an open question. So in my mind, that doesn't guarantee we're going to see inflationary policies come to fruition over the next 6 to 9 months. I think the third scenario is more optimistic. And so let me just set the scene a little bit. The blue line is showing you productivity growth in the United States going back to 1990. So if you're investing in the 90s, obviously, right, it was during the internet era, the advent of the personal computer, the internet's networking together computers and so forth. And we had a big surge in productivity growth, which means the economy was able to grow much faster than it had historically without any inflationary consequences, which was good for wages, good for corporate profitability, was good for the equity markets. You know, the last couple of decades, we've been in a productivity slump. Productivity growth has slowed up until, basically right around COVID, where productivity growth started to pick up again. So I think the optimistic scenario for the US economy for the next 2, 3, 4 years is productivity growth continues. And it's driven by AI to some extent. I think it's driven by a very tight labor market, forcing corporations to basically do more with fewer labor inputs. And there's a number of other factors that seem to be driving productivity growth. But to the extent this continues, I think this would actually be a fairly bullish tailwind for the US economy and for the markets over the next couple of years. So which of these scenarios is most likely? I think the recession is pretty low odds at this point, right? We've seen the big increase in interest rates. It's clear that didn't trigger a recession in the US because consumers and corporations locked in a lot of their financing costs 4 or 5 years ago at very low rates. And so they weren't susceptible to significantly higher interest rates. So I'd put a number less than 10% of a recession. You might differ, but I think it's a low odds scenario for the next 12 months. The inflation scenario, I guess I'm more worried about, but I don't think it's the majority scenario at this point. I'd say 1 in 3. It could be driven by tariffs. It could be driven by fiscal policy. But I think we're yet to see what fiscal policies can pass through Congress at this point. So I'm skeptical we're going to see a big dose of fiscal spending over the next 12 months. We might, but I'm skeptical at this point. So where that leaves me is that the productivity growth scenario seems the more likely scenario. The U.S. economy's a super tanker. Once it's on a course, it's hard to change the course that it's on. And so I think it's likely that AI revolution, tight labor markets continue to lead to gains in productivity, gains in wages, gains in corporate profits, which should be a tailwind for the equity markets and means that inflation doesn't have to become a problem over the next couple of years.
Charles, you mentioned AI. Do you think we've kind of seen AI increase productivity already, or is the market expecting that's happening, few years out? Where do you think we are there?
Yeah, I think that's a key question, and I'm not sure anybody's got a good answer for that yet. I think economists, analysts are struggling to quantify how AI is impacting the economy in a real sense outside of just the enormous amount of capital spending that's taking place to build out AI capabilities. But in terms of driving productivity growth, we don't have a good handle on, has it happened? Are we on the cusp of it happening? I think it's one of those evolving issues we're going to learn more as the next 2, 3 years progresses. I think we know for sure that AI is leading to an enormous amount of capital spending on part of Amazon, Microsoft, Google, and so forth. And that's showing up in the profitability numbers. Um, my hunch is the big gains in productivity to date have been driven largely because of a tight labor market. So corporations have invested in capital equipment because they can't find workers, which is good in a sense because it means the productivity gains from AI is still ahead of us.
Okay, interesting. And then, I think one of the things that's interesting to me with, the odds here of these scenarios happening is we've already, you know, seen so much in the news this year, or, so much has already happened. And I'm wondering, with anything that's happened from, over the last few weeks, if any of this has impacted your thoughts kind of on the probabilities of these different scenarios.
Yeah, that's a good question too. We struggle with it, right? Because there's so many moving pieces, and trying to distinguish between, I wouldn't say it's noise, but there's a lot of moving pieces that don't directly impact the economy and the markets. So it's hard to quantify, for example, right, what's going on with Ukraine and Russian negotiations. Does that have an impact on the markets in the US economy? And so it's less than clear in our mind that it does. So a few of the issues do, but again, even if you take tariffs, I think it's less than clear that they have to be inflationary. If we see continued ratcheting up in tariff tensions, I'm more worried that it could be more raise the recession risks than it would increase the inflationary risks. So since we did this at the end of 2024, we haven't changed the probabilities. We haven't, in my mind at least, we haven't seen a big enough slew of real economic initiatives that have moved these in any meaningful way. I think the next shoe to drop will be what happens with the budget negotiations, right? Do they just get locked up in controversy and we have a government shutdown in March or April? Or can the Republicans come to an agreement where we see another big bout of fiscal spending? I think that's the big decision that's pending that's likely to move these odds. And like I said earlier, I'm sort of skeptical we're going to see another round of fiscal spending, but we'll have to see. And if we do, we'll adjust the odds and we'll adjust the portfolios accordingly.
All right, and I guess that leads to my next question of kind of given these most likely scenarios, how do you navigate this from a portfolio standpoint?
Yeah, so this is a good summary of how we've tilted the portfolios. So, if you're a typical 60-40 allocation, ETFs on the equity side, maybe it's some mutual funds, PIMCO incomes of the world on the fixed income side. This would apply to your portfolio. So, number one, we're still underweight international. Even though international has picked up some speed this year, I guess we're skeptical that it's durable. We would still overweight the US markets relative to the international markets at this point. I struggle to see how a ratcheting up in trade tensions is going to be good for Europe in particular. So we're staying overweight US versus international. Point number two, we're underweight small caps versus large. I mentioned earlier how corporations have locked in their funding costs, 3-4 years ago at very low rates. That's true for large companies, but it's not true for smaller companies. So if rates were to go up meaningfully over the next 12 months, I think small caps are at a real risk of a profit hit because of rising rates. Point three, we're equal weight growth value, right? So there's a lot of debate. Should I be buying more of the Magnificent Seven, buying more NVIDIA, Microsoft, and so forth? And it's tough at this point because those stocks are expensive. When you look at price earnings ratios, price to sales ratios, they're at the upper bounds of where they've been historically. And so we wouldn't make a big bet on growth stocks at this point with equal weight value versus growth. And I think if inflation does come back, even though it's 1 in 3 odds at this point, I think if we see the policy decisions that brings back inflation, I think growth stocks are at a real risk of a repeat of 2022. I don't think it's necessarily likely, but there is that risk. And then on the fixed income side, if you've listened to these over the last couple, 3 years, we've talked a lot about staying short maturity, that you weren't being paid to own long maturity bonds. There was a lot of risk in those. And we're still the same. We would still favor 2-year treasuries or shorter than, say, a 10-year treasury or a 30-year treasury. You give up a little bit in yield, but you're taking a lot less risk in terms of price changes if rates go up. So our bond portfolio has a lot of short maturity fixed income securities earning 4 to 5%, relatively safe. You know what you're going to get. So those are the 4 key tilts we have in all the portfolios, regardless of the stock to bond mix at this point.
Awesome. This is super helpful. And I think one thing that is really interesting to me, at least around the fixed income side, is the bond side is, typically, you want to have shorter duration in a rising interest rate environment, but you want to have that duration there in the recessionary environment. So kind of balancing out that, we could see both of those and then kind of arriving on somewhat of a balance there between, wanting to be short duration, but not too short.
It's certainly a trade-off. Yeah, that generally those longer maturity bonds are your inflation hedge. And I think if our odds of a recession go up, we'll add to our intermediates, our long-term bond portfolio positions. So we'll manage that as the odds change. And so I think the key is just going to be we're going to have to be flexible over the next couple of years. There's so many moving pieces. We're going to have to stay flexible and be willing to change the allocations as the news changes.
Absolutely. And I think, let's end with that. But I think flexibility is is a really important word right now, particularly as we look at retirement planning. And, I want to encourage everyone on this call, if it's been a little while since we've looked at your retirement plan, let's look at that. And I think, there's other things, we're focusing on the economy and markets during this presentation, but I think there's other things as far as retirement planning, that are also impacted by, recent changes and the stuff we're hearing in the news. So if you have questions about kind of, how that impacts your plan, let's get together, because I think in addition to having flexibility in the investment portfolio, we're going to need to have flexibility in the retirement planning as well, right? How does this impact Social Security? What does that look like? And really, being flexible to make changes and running different scenarios is there as well. So with that said, Charles, thank you so much. Really appreciate your time and expertise here, and value your continued partnership, and really, looking forward to seeing, what markets do this year, and what, flexibility comes as a result, moving forward.
Anytime, Liv. Happy to do it.
All right. Thanks, Charles.
Thanks, everybody. Bye-bye.